Hello and welcome to Market Domination Overtime. Let's take a look at how markets ended the day right here on the Wi-Fi Interactive. Large caps back in control. They've been underperforming the small caps for most of January, but here we got the Dow up 313 points, or about 0.2% off of the highs of the day there. So not a bad way to start this week, especially with this big storm causing a lot of outages over the weekends. NASDAQ Composite up about 0.4%, and the S&P 500 up about 0.5%. And I mentioned the small caps. They weren't doing it today, but we're going to speak with a small caps expert in just a few minutes here. You can see they closed the day down about 28 basis points, or 0.25%. S&P 600 just barely in the green. There's small caps too. And I like to show the mid caps now. Just a little bit of negativity right there. Let's scoot on over to the large cap sector action. And it looks like utilities pulled out a win against tech. So kind of a reversal over the last hour. Both of those up more than 0.7%. Then you got communication services and financials. All four of those outperforming the S&P 500. To the downside, what didn't work today was those consumer stocks. So XLY is consumer discretionary. XLP is consumer staples. Staples a little bit less bad as Walmart and Amazon and some of those bigger companies, although Amazon is discretionary. Some of the larger companies that sell you what you need doing a bit better due to stockpiling. And here we have Apple up almost 3%, Tesla down 3% among the mega caps, Broadcom up 1.5%, Meta up 2%, and Alphabet up 1.6%. But it wasn't the best day for the semis. We had some winners, some losers here. AMD, a notable standout to the downside, down 3%, and Intel down 5%. NVIDIA itself down about 0.2%, and Micron off about 2.5%. And Software finally shining here and outperforming chip stocks, and that is another reversal of the year's trends that we have seen so far. Oracle up 3%, so is Cisco, SAP, and CrowdStrike up about 3.5% as well. And let's close out here with the Dow Jones Industrial Average. Aside from the large caps that we saw, Walmart actually ended the day down just slightly, but JP Morgan up 1%, Cisco up 3%, Caterpillar up 1%, Goldman Sachs, IBM, Amgen, and McDonald's, all of those up more than 1%. And it's been a strong start to the week for the markets, but not so much for small caps. Russell 2000 underperforming on Monday after the index has seen some wild swings in recent weeks. Joining me now is Impax Asset Management's Nathan Moser. Nathan, thank you for joining us here today. And I was just perusing X, and I saw this stat by Ryan Dietrich. As of Friday, the Russell 2000 had outperformed the S&P 500 for 14 days in a row. That was a record. So today's kind of an anomaly, but the big question is, are small caps finally here? Do they have a shot at a lasting, sustainable rally?
Well, thank you for having me. Really great to be here with you. And the short answer is yes. I think they do have the potential to outperform over the long term. I think part of it, you have to think back to where we've come from. We've come from more than a decade of underperformance relative to large caps. As a result, they're under-owned as an asset class. Their relative valuation is quite attractive. And I think as we then turn the page and start thinking forward over the course of this year, as the U.S. economy accelerates, small caps are very well positioned to continue to outperform.
So tell us about some of the factors and maybe some of the sectors and industries within small caps that you're looking at that kind of excite you right now.
So I think again, we've seen outperformance of small caps since the April tariff-related lows. And so obviously the beginning of this year has been quite exciting for small, obviously a normal experience in markets that give back a little bit of that strength in the last couple of days. But when we look forward, we see the baton being handed off from that lower quality cohort of stocks to higher quality small caps. And so at Impax and in my strategy, we are really taking a quality approach to investing, preferring companies that make money, that have good balance sheets, and can generate strong, predictable free cash flow. You asked about the sectors.
Yes.
We're playing a bit of a barbell. I think growth and value stocks can outperform. On the growth side, our preference is for healthcare, which is playing an innovation theme. And then on the value side, or the more cyclical side, I think financials are well positioned, specifically the banks and the asset managers.
It's interesting you mentioned healthcare and the banks. Both of those potentially benefit from an agenda of deregulation, which we have definitely seen promoted over the last year. How much of that is an existing tailwind, and is there more of that to come? How important is that?
So I think deregulation definitely benefits small caps. Regulation, if you sort of define it, really negatively impacts smaller companies. The large cap companies have lobbyists just due to their size and scale. They tend to be able to withstand regulatory changes. So as some of the regulations are rolled back, we're going to see small caps incrementally do better. With respect to healthcare and financials, financials in particular are likely going to benefit with respect to M&A. And so we're seeing that over the last several months. Some larger bank deals have gotten announced. They tend to be closing a bit faster these days. So we expect over the next couple of years a bit of a resurgence in bank M&A activity. And then on the healthcare side, that's a little bit less related to regulation and much more just based off the industry dynamics. And so the key dynamic there is large cap pharma needs to replenish pipelines. Smaller and mid cap biotechs are well positioned to be targets and help them drive future revenue and earnings growth.
Just in the media in general, we tend to cover large caps more and some of the big flashy names. But let's say I'm an investor. I'm looking to dip my toe in the water here in the small cap pond. What do I need to be on alert for? Because we don't always have the same analyst coverage, especially in the small names. And the SEC filings might not be vetted by big name auditors. Just in general, how can smaller investors be taking into consideration some of the smaller cap companies here?
I think over the long term, the best advice is to stick with quality. That when we look back 30 or 40 years, quality small caps outperform lower quality small caps. And so I would not get caught up in the exuberance that we see in some of the pockets of the Russell 2000. I would really focus on the approach of slow and steady wins the race. And so depending on the individual and their long-term goals, really focus on that quality aspect of investing.
So let me bring this up too. Do you go for an ETF that covers an entire index like the Russell 2000, or do you go for individual industries or sectors? And I'd also add that Russell 2000 allows unprofitable companies into the index, whereas the S&P 600, you got to be profitable to get in.
Yeah, I think that, again, it depends on the investor's capabilities and their risk tolerance. As you mentioned, the Russell 2000 tends to be a bit lower quality than, say, an index like the S&P 600. I am an active manager, obviously understand the benefits of ETF or passive vehicles. I would tell you that in small cap land, active management tends to work quite well. It's a less efficient part of the overall market. And so we've seen over time that active managers can add alpha in that asset class.
All right, Nathan, really appreciate your insights and stopping by here.
Thank you.
And Elon Musk has made big promises about the future of robotics, saying he expects to begin selling Tesla's Optimus by the end of 2027. You can see it right there. But while Musk is focused on humanoid robots, other companies are focused on how the technology can be used for other real-world functions. The CEO of Gecko Robotics joined Julie Hyman on Market Catalyst this morning to discuss where the real ROI in robotics will likely be found.
When you get down to the hype of AI and artificial intelligence, what you begin to realize is you interrogate the information, data sets, and actions that go on, especially in these like physical worlds and sectors, and you realize that there's actually a fair amount missing as it relates to the infrastructure that can power such the gains in the ROI for AI. And so a lot of the CEOs that I talked to in the energy, manufacturing, and then the folks and decision makers in the military, they're very much interrogating, okay, where's all the information, data, and gains and ROI that we been promised. And so this is why there's such a boom and a focus on robots, is because they help to fill this huge data gap and an action gap that exists in the real world where ROI is created.
And so, when we're showing some of the footage of Gecko's robots, And so what you're talking about is less like a robot that will do things for you, although there is some of that, and more of a data gathering device, to your point, sort of being able to map in AI what exists in the physical world, right?
Yeah, that's right. I think one of the things to really drive home the point of, look, I started this company 13 years ago before robots and all the sectors that we're talking about were cool and kosher to talk about, especially from Silicon Valley. And so what we began to realize back 13 years ago was that the information, the actions, the things that in the real world that can really drive transformational change for businesses is actually focusing on the business outcomes, whether it's creating kilowatts, refining petroleum or hydrocarbons, or it's getting ships out of dry dock faster to deter conflict around the world. And so this is the thing that we wanted to focus and wanted to create a vision for robotics to be able to pave the way to create these incredible gains and change the way that these businesses can actually run, decisions they can actually create and make, and actually do it as well safer and in an environment that allows for you to get the most ROI possible, with both these droids that you see here and then also the humanoids that are coming. But the thing that's missing and has been missing has been a universe and a platform software-wise where all the information and data can go. And that's why we had to make Cantilever, which is what we sell to our customers.
Gotcha. In addition to the robots that are gathering the info. Now, are you guys developing a humanoid as well? Or is it a matter of that when humanoids get developed, they'll be able to, sort of upload the data they collect into your system?
We are creating the infrastructure and the nervous system for those humanoids to be able to actually be as impactful as possible. I mean, what's so cool and so interesting when we see these humanoids, we see ourselves in them, right? We're like, we're creating these generalized robots that we want to be able to take on some of the tasks that we don't like to do, folding laundry or making food or cleaning dishes. What we don't talk about is there actually a ROI to that? Am I going to spend a bunch of money, to be able to have a robot do that? And the reality is most likely not. And so the question is actually, how do you employ robotics to actually drive massive amounts of ROI? And you have to create a structure, a platform where all the information data sets, for robots can go to. And the most ROI you can create is actually in the sectors that I was mentioning, like the energy sector, the Department of War, these manufacturing sectors, these dirty jobs that actually drive GDP. And so, that's what the robots that we focus on building are oriented towards. And then we kind of want to see the value that humanoids and mobile robots can bring, because I can tell you something, it's not as much value. These like walking and these walking around robots aren't exactly the most impactful as it relates to changing the way that these companies and these sectors operate and work. They will. But the key is to focus on the kinds of tasks, the kinds of information that can drive the kinds of decisions that weren't possible before and can actually have high ROI. Everybody's focusing on this question right now because they have to be able to justify all this investment into infrastructure and technology. And they know that this will be the differentiator, for these companies in the next 5 or 10 years. It's going to completely upend, who is the dominant players. Like in the Middle East, for example, I was just there for ADIPAC and UAE and Abu Dhabi, and I got to see firsthand, some of the aggressive moves that CEOs like Dr. Sultan Al Jaber is taking, because of the core belief that this will fundamentally change the chessboard as it relates to the global economy. And so, those that adopt quickly are going to dominate the next 5 or 10 years.
Coming up, we get an analyst take on Lululemon's latest controversy next on Market Domination Overtime. Lululemon has been under fire for selling leggings that customers complain are see-through when they work out. This isn't the first time Lulu has faced backlash for its clothing quality, and this time it comes as the apparel company is in transition, seeking a new CEO and facing activist pressure. Joining me now on this is Adrienne Yee, Barclays Consumer Discretionary Analyst. Adrienne, thank you for joining us here. How does Lulu right the ship? So as we said, the CEO is out at the end of January, but the founder, Chip Wilson, has said there's been a loss of cool, and this is the second time within a year that they've had these quality control issues.
Yeah, so this isn't even the first time that we've had kind of a product issue. Recall back in 2013, the company had to remove, a significant portion, a double-digit portion of its bottoms because of quality control issues. What I would say is, now what's happening is we're much further on as a company, as an organization, and really what's happening is there's almost a panic to get newness to the market. So they talked about infusing about 35% newness starting in the first quarter of this year and kind of rolling throughout the rest of the year. What that does is it doesn't give you a lot of time to test in the marketplace and get feedback. And so that's one of the risks that we see them facing this year.
Well, and apparel in general hasn't had the greatest start to the year. I'm talking about stocks, and you're in the consumer discretionary analyst group here. Talk to me about what it would take. Are these macro headwinds? Is it just cyclical? What does it take to get some of these stocks back on track?
I think a couple of things. These stocks hit kind of bottom, right? A near-term bottom in probably the October, November timeframe. I mean, this was the worst place to be from consumer discretionary goods. If you look at the sector relative to all of the other sectors, it was a straight kind of like do not touch. And I think at the back end of last year, we realized that some of the tariff pressure was known. It was in the stocks, or at least it was in the models, right? To the extent that it was going to be a net neutral as we go into the full year, worse in the first half, better in the back half, we're going to get price increases. So I think really what you need to see here is that the demand as we go into the first quarter, that there is stimulus that is driven by the one big beautiful bill, as well as past Fed cuts, right, to stimulate the consumer and to drive them to continue to spend, notwithstanding the fact that basically your entire wallet is going to be inflationary, right?
Yeah, well, and not only that, we just had a winter storm pass, which is definitely lowering consumers or separating them from the ability to spend that money at stores. I want to shift gears a little bit, and we're going to talk about Nike. I just saw this header across. They're terminating 775 employees as it accelerates automation at U.S. distribution centers. And I don't know if you've read the report, but just talk to us more generally about the influence of automation and maybe AI kind of creeping in and reducing headcount and maybe increasing profitability.
Yeah. The first place that you're going to see it, I mean, there's a lot of talk about agentic search and how that was up 700% during kind of Black Friday. I mean, we're really starting to embrace the information, the data flow. I think what you're really going to see, retailers, generally speaking, historically have been sort of behind, right, in terms of investing in all of this technology, et cetera. The functional aspect of digital and data, that has kind of forced people to gather that data. So the good part about omnichannel and digital is you have that data there, which they otherwise may not have had if they were only doing brick and mortar. And so what I would say is the first place you're going to see it and the easiest place that you're going to see it is inventory management, store payroll hours, kind of managing those hours, and through the supply chain, as you're mentioning right here. So I do think that the first place is cost reduction, and then the second place, which takes a little bit more personalization, finding out about that customer, doing a personalized search, and customizing their CRM systems. That will really drive the demand side of it. But I think you're first going to see it most easily deployed sort of on the cost side of things.
I appreciate that. And as we head into earnings season in a few weeks, we're going to really get the retail crowd and a peek into what's been happening over the holiday quarters, and also more importantly, a look ahead into the rest of 2026. What do you expect? What are some of the tailwinds, headwinds, et cetera?
Yeah, the tailwinds are freight is your friend, right? So oil's been coming down. So that's a new tailwind that we have kind of this year over last year. If you're an apparel manufacturer, cotton's your friend. We've seen kind of slight benefit in the third and fourth quarters coming from those who do a lot of denim, like a Gap. And then I would say the other tailwind is going to be as we anniversary the back half of this year, you're going to get the kind of stabilization of the pressure, right, of that tariff. Tariffs seem to be, the discussion is sort of net to the things might be a tiny bit better. So that's also kind of, not worse. And then the last part of it that kind of is the overall is what happens to the consumer when we raise prices 2, 3, 4% starting this season. And that can be kind of offset by some of the stimulus that we expect to come to the consumer. So net, we're looking at a flat to expanding margin year in 2026. We're not entirely kind of negative on this space. And what I would say is we get incrementally more positive as we head into the back half of the year. So we have a risk on for consumer discretionary. And we definitely think that you need to have some of that in your portfolio in the instance that we do get a little rollback on some of that tariff pressure.
Ton of insights there. Really appreciate your stopping by here. Thank you, Adrienne.
Thanks so much.
Time now for What to Watch, Tuesday, January 27th. The earnings season is heating up. We're going to be getting reports from some big names, including United Health, Boeing, and General Motors. Boeing announcing results for the fourth quarter before the markets open. Analysts expecting the plane maker to do better this quarter on a year-over-year basis, driven by more plane deliveries and its defense business stabilizing. Taking a look at the Federal Reserve, the Fed kicking off its two-day FOMC meeting on Tuesday. The Fed widely expected to hold rates steady, and we're not getting any new economic projections at this meeting. Leading up to the meeting, many policymakers signaling policy is in a good place. So all eyes turn to Fed Chair Jerome Powell's news conference Wednesday for how long the Fed could hold rates steady before cutting further. And checking in on the consumer, fresh data coming out on Tuesday with January's consumer confidence. Economists forecasting that numbers to increase to 90.1 in January, suggesting households are feeling a bit more optimistic about the overall economy compared to the previous month. And that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Thanks for watching.